in different markets. And that was really important to, me ultimately kind of launching my business. Okay. So, how I achieve financial freedom. So I think this is different to everyone involved. Some might say it's a certain amount of income. Others might say, hey, if I just cover my expenses, I've got financial freedom. Others might say, hey, I never have to think about working again. And so I throw that out there as it's part of your goal, kind of defining what it is that you want. And when I first made my leap from the corporate world to launching my own business, I had enough passive income coming in from my passive investments that would cover my expenses. So it wasn't definitely enough to really live the good life, but it was enough to know that, look, if this didn't really work out, I had a base that could buy me time or get me to a place that I could pivot if needed. So that was really important. And I'd also had a couple other side businesses that I had income coming in from as well. And so the whole idea was to have my money working for me. But I was able to do that, which kind of freed up my time to then make the leap. And I also spent about a year or so when I was in a transition mode, I would say. I was still working full time. I was, investing on the side, and I was also, launching my syndication business. And to throw in a few other things, I was also getting my MBA at Notre Dame, and my second daughter was born all in the same year. So I always say, it can be done no matter how busy you are. You just have to prioritize and, be very disciplined and have some good time management. But I took all that on the first year I launched my business, and it was not easy, but it was something that I felt like the time of my life. It was a great opportunity to really go for it, and so I put everything I got into it, and now things are in a much better place. I only have one full-time job, I should say, that I do, and this isn't a job; it's just more of a passion. But it has definitely freed up my time, and so I knew a number that I needed to at least hit to get to the cash flow level that I needed. And one other thing that's important in these deals are the tax benefits, and that's something that I think for someone that was leaving a corporate job with a nice income stream attached to it, with depreciation in these investments, it allowed me to keep nearly everything that I was making. So I didn't have to, really replace my full income because, I was getting taxed at almost, 50%. So I think that's something that's important to factor in if someone is looking to make that leap or that jump. At some point, these are very tax efficient investments. You don't necessarily need to make as much money because it's all about, what you're taking home or what you're, being taxed on. So that's just an important point I wanted to stress. All right. So the active syndication part. So once I left my job, I, for a year or so had spent it really networking with people that I'd, come in contact with, built relationships with for 15, 20 years, in the business world. And I was just really, impressed with how many people like that were interested in these types of investments. And I put a list together. I think it was like 250 people in my network that I reached out to, and it was, hey, let's catch up for some coffee. I want to share, what I've been up to. And I think there was only about 5 people that said, hey, I'm not interested in getting together. And so the rate at which I was able to connect and network, probably the first 6 months of my business was super important. And then I saw the high level of interest I had. I really felt like I was onto something. And it was, again, just, helping educate others, showing them, hey, here's what I'm doing. And it started with, these are the passive investments that I've made, and here's my experience, and here's, kind of what I'm seeing, and that, I'm seriously considering, going into this full time. And it was just a lot of that. I would say, you want to do that ahead of time if you are thinking of, kind of going down that path. So, it's not like you make the switch cold turkey and then you're out looking for, investors for your deals. I mean, it's a process, and it takes time. And, I was very intentional with, what I wanted to do, but, I always took the approach that reaching out to people, I felt like, it was an opportunity. There was never any pressure to invest. And the people that I sat down with initially, I would hope that, they would think highly enough of me if they had a great idea or something they wanted to share with me, that they would reach out and call me. And so that was the mentality approach. So it was never, it didn't feel salesy. It just was so natural. I felt like this is the role that I was born to do. I mean, honestly, like, it might sound cheesy, but I've done a lot of different things in my life, and, being a syndicator and, full-time investor, I mean, this is what I've always wanted to do. And I absolutely love it. And like I said, it comes so natural, and to be able to help others, is really what makes, I think, syndication very fascinating and very fulfilling as well. So with that, the networking and relationship building, that is critical, whatever you're doing in life, just because you never know, where that's going to come into play, and was a big reason why I went and got my MBA. It wasn't something that, I was going to go get, and then all of a sudden, I'm going to get a big pay raise. I mean, because I was in a business where, the money I made was based upon, the deals that I closed and the relationships I built. So I felt like I could be part of a great network and really, build some lifelong friendships. That was the goal. And so I got the most out of that experience. It was not necessarily about the grades I got. It was, the people I associated with, the people I connected with. And that really kind of helped launch me, into my business, because I was able to run some test cases while I was in school and do it in real life. And it was great. So I had some fun with that. And then really what got me started was I started partnering with others who were already in this space that were doing well. And, I just tried to provide as much value as I could. And the one thing I had early on was a pretty big network of people that I knew had interest if, they were able to participate in some of these opportunities, or they were just made aware that these opportunities exist. I felt like I could bring a lot of value to a sponsor in helping, put the deal together. But a big portion of that was working with investors. And so, I started kind of with one opportunity and then just grew it from there. And then also, built up a few more relationships. And then, then before you know it, I look back, I'm like, wow, we did 10 or 12 deals in our first year, and everything is kind of moving in the right direction. And the first one's the hardest, as they all say, but once you kind of get through that, it does get a little bit easier. And, you got to really think about, how you're getting, your brand out there, and how you're, letting people know what you do. So social media does become a big factor in kind of getting that word out. So I do a lot of podcasts. I try to, be as helpful as I can, share a lot of, good industry articles, things that I think are important and other people would want to know. So I'm constantly trying to do that. But to kind of hit on the point, Emma, that you had asked about, like, diversification and the different investments that I've done, I think that's key in any sort of investment that you're going to be doing, because, you never want to put all your eggs in one basket, so to speak, and you never want one deal to make or break you. So when I looked at, like, what I was doing from a passive investing standpoint, I wanted to put money into good deals with people that I felt good about, that had, solid track record, that I felt like, they wouldn't lead me astray. And I know that, in nothing's guaranteed, and, things happen, but I felt like, if you could get in bed with good people that care about, what they're doing, you're going to end up, being in a good place if you diversify properly, because there's going to be deals that really outperform, what you maybe thought the initial expectations were. And there's probably going to be a lot that come in line with what you were thinking, and there's going to be a few that underperform. And if you take a kind of a blended overall approach, I think you'll end up fine, because that's the approach that I took. And it's what makes me sleep well at night, knowing that I'm very well diversified. And I will say, as far as the breakdown of asset class, I mean, value add multifamily is where most of my capital is. But even with that being the case, I'm diversified with probably 10 different sponsors. I'm in probably 15 different markets. And within that, I'm in different asset classes. I'm in Class B properties, Class A properties. and Class C properties. So if you can see just multifamily alone, there's a lot of different ways to diversify. And, it's not like I have every single one of my multifamily investments in Jacksonville, Florida or Dallas. It's all spread out, and it's all by design because I want to be in a lot of great markets, and I don't want to have, everything all in one place. And, I would say secondarily, it's a lot of niche asset plays after that, with mobile home parks, self-storage. We have an ATM fund. I did a litigation fund, a hemp farm, and those opportunities are cash flowing deals that are outside of multifamily in there, in what I would call more of your niche real estate markets. And then I also do a lot in angel investing, and that's a completely different ball game. It's a type of investment where it's a long-term play. It can be a pretty big gamble because there's going to be a lot of failure, but you're hoping for kind of one or two moonshots that might 50, 100x your initial investment. So that's a long-term play. It's not a big portion of what I do, but it's significant enough that it definitely is something I've looked at as a long-term play where typically they say you want to invest in about 20 different companies to really get the diversification you need in the angel investing space. And then I see an XRP, let's go. So cryptocurrencies has been kind of a new investment vehicle for me. There's a lot of reasons I do like it. It's a way to stay somewhat liquid, so that instead of having my money sit in a checking account or savings account, I can put it into action and have it have it grow, and then be able to pull it out if I need to, versus the money I put into syndications. That's a long-term play, a long-term investment. I kind of act like it's not even there. So the cryptocurrency, there's going to be a lot that is happening. There's a lot of exciting things coming. I mean, it is like getting in the ground floor when the internet, was first invented. And so I think there's going to be a lot that will transition over into many different industries. And it's something that is still really early. So I think, there's a tremendous amount of opportunity. And so it makes the investing fun because they all play off of each other, which is, what I also learned kind of growing up, and also, talking to a lot of other successful business owners. I mean, all it takes is one really successful, business or, job that you have, and then that you can create multiple streams of income through that. And that's essentially what I've done. I've taken one business, leverage it to build another one, to invest in this one. And I just keep stacking it over and over again. And then eventually all the cash flow and the exits, those starts to snowball after a while, and it's a lot of fun. So I would say, if you can kind of, go deep into something that you're very passionate about, that you can do well with, and then, if you have any discretionary income or other, investable assets or cash, you can put it to work, and it's amazing what that can do over time for you. And so that's kind of, where I, like to spend my days, working with investors and our operating partners who we closely work with. And it makes it fun, very dynamic, because I do get to see what's going on in multiple markets at any given time, just given all of our different investments. As I mentioned, I think we've done over 45 deals. And so feel like we've got a pretty good pulse on what's going on. Obviously no one has a crystal ball, but I think at the end of the day, there's a lot of, good things that are happening. There's some things that, might give me a little bit of pause here and there, but certainly we can kind of maybe keep that open for discussion here, because I think that's something everyone's kind of trying to get their arms around. So with that being said, I know I've kind of talked a lot. I've shared a lot. I wanted to kind of just give an overview of, my story and kind of how I transitioned from, being a passive investor to the active side, leaving, the corporate world, and really just want people to know that, anything is possible. I mean, these were things that I had set out. I laid out my goals and my why, and really felt like, I was going to do this no matter what. And probably the biggest thing, I just didn't know how quickly it would happen. I thought this might take many years, but it all happened in a very short period of time. And I think that was because I was ready. I had built up a lot of solid relationships, and I had some capital to play from another business I'd started, and I was really able to deploy a lot of that in a short period of time, and that just created a ton of momentum and really kind of got me to where I am today.
I wanted to ask, I had a speaker at my meetup a couple of months back, Monique Halm, and she mostly is a capital raiser.
Mm-hmm.
And she had some pretty diverse, almost wacky types of real estate investments. She had, at that time, had recently bought like a baby food factory and some frozen pie factory, something like that. And I said, well, that's kind of odd. I mean, how do you become an expert at baby food and pies? And she said, I'm not the expert. I partner with experts and then I raise capital. She said at the bottom of that barrel, it's always real estate. And that's what she's an expert at. She doesn't have to be a specialist in everything where she deploys her capital and her investor capital. So how much do you find, what do you feel like you're really an expert at that you feel very comfortable being 100% in control of? And what types of things are you invested in where you're like, I don't know much about this and I don't really want to know much about this, so I'm going to throw some like dollar cost averaging type of passive money at it?
Yeah, I mean, I would say, I mean, the biggest thing is, if you can surround yourself with people that are, successful, that are doing the things that you want to do and you trust them, those are great relationships to have, especially if you're going to be investing. The first 5 deals I did with my teammate's father, who he'd been kind of like an informal mentor to me over the years, just sending me books on, multifamily syndications. And so I knew right away when I had my first, opportunity, I was going to him, and it was just through that relationship. And so, they got a great track record, and it was a way for me to feel comfortable, like that. I didn't have to really question what they were doing. I knew he had to run a business for 20 years and just done very well. And so I think if you can identify people, I think that's one thing that I'm good at is, aligning or associating myself with people that are better than me, that are smarter than me, that are in different places than me. But when we come together, I help make their business better, and they give me an opportunity that, I can then bring to others that would really be hard for anyone to kind of get on their own, which I think is the true definition of a syndication anyways. And so at being at the heart of what's going on and just being very well connected, I think has served me well. And it's something that I continue to keep building off of, because, getting access to opportunities and information that's can be priceless. And so I'm trying to kind of, put everything together, and I want to be at the table. If there's a great deal going on, I want to know about it. And so that's where I think, my value is. And, not probably going to be the person that's going to find the deal, but I'm going to find the team that's going to find the deal. And that's really served me well. And the investors, I think, realize that that's the role that I'm playing. Even though I'm involved every step of the way, I'm not going to be the guy in the weeds that is going to be able to, answer a really detailed question about the pro forma. It's going to be high level with people that I trust. And I think that, it is a good way to look at investing long term, because I see so many deals out there. And at the end of the day, all the numbers start to look the same, and all of them are projections. They're usually all within 1% or 2. So I really believe the most important part is the people behind the numbers. And if you get that part right, in the long run, you'll do well. And I know you had another question about certain investments that you kind of just put some money in and hope that it goes well. I would say, a lot of the angel investing I do is kind of like that, because, each business I invest in, it could be in a totally different industry that I don't know anything about, but I know in some of my angel investing groups that, this is one that everyone's going in big on, or the number of people investing in it are, it's really high. And so I put a lot of weight in that, these people that are smarter than me, that have industry knowledge and technical knowledge about these businesses and all the different metrics that go into it, I trust them enough that I'm willing to invest if they are. And so that's an area where I don't get too, I get all the reports, but to read through 20 pages of all the different metrics, I'm a type of guy, give me the 5 bullet points, or, we moving in the right direction or not. That's to the extent that I care about, those types of investments, because, it is a 7 to 8 year hold, and, only maybe 1 or 2 are going to really, make up all your returns. So it's really hard to kind of keep track of everything. I will tell you, the crypto, that has been something completely new to me, but I jumped into it, with 2 feet, and I said, I'm going I'm going to learn as much as I can, because, what I was seeing was just an opportunity that, being in at the ground floor, and the amount of money that can be made, and the amount of innovation, it was worth it to me. I hired a couple coaches. I got into same thing like I'm doing with real estate, building out the networks. That's what I'm doing in the crypto space. And it's worked out well for me so far. And I'm having a lot of fun with it. And it's a way to diversify some of my investment, just because I am very heavy in real estate because of what I do. And I do like it for the liquidity, purpose, because I can, just like with, say, Bitcoin, for example, like I could borrow against it if I needed to, just like owning a rental. I mean, you could take and get creative and not have to sell the asset. So I do like some of that. And then there's also, different staking you can do. There's passive income that you can get from, holding these different cryptos. So very, very fascinating space. And I'm by no means an expert, but, again, I'm surrounding myself with people who are, and, I'm getting good intel, and, just, again, a lot of this is, you're never going to know probably 100% that, hey, this is the right decision. But if you can get 85, 90% of the way there, then it's, you gotta make that jump and that leap. And that served me well, because, I don't think you're ever going to have the perfect scenario where all the answers, and and there's no risk, because if that's the case, then that's probably not a worthwhile investment. You got to take some element of risk, but if it can be calculated, and you believe in the team and the people involved, and the business plan aligns with your goals and objectives, I mean, then it's go time. It's putting it into action, and that's something that I think is super important, instead of talking about the deal or the scenario or the dream. You got to eventually do it and act on it to really kind of see if it's gonna work.
And I feel like I'm asking my investors not to trust me, because there should never be just blind trust. Oh, whatever you're investing in, I would do. That's, to me, is a lot of responsibility and a lot of psychological weight that I don't want to carry around. But at the same time, I'm not asking them to be an expert. I'm asking them to let me be the expert, and that they need to have a certain amount of education in order to feel comfortable investing, but not so much that they could come in, sweep in, and take over the property and turn it around in 30 days if it's going badly. And I'm finding that I'm tending to do the same thing with other people that I know in my network. And we'll start, for example, I mentioned before that when my parents passed away, and we the kids split up an inheritance, and we're investing it in very different ways. And so my one brother, he's a full-time stock investor, and he wants to talk to me about stocks, and I don't get it. I hate talking about it. I've been trying to invest in stocks for almost since high school, really. And my grandfather actually became financially independent from stock market investing. And so when I found that out when I was a kid, I thought, I'm going to invest in stocks and be like Grandpa. And after 30 years of trying to do this, I realized I'm never going to get it. They just don't like it.
Yeah.
And so I asked my brother, I said, give me your pie chart that you're using on your stock investing platform, and just send me that. And I just started throwing money at his pie chart. And I can sync it to his chart in this program that we're sharing, and I can create my own, but I'll just keep syncing to whatever he's doing, because he loves it. He checks the business news every morning, and I'm able to still be invested in the stock market while I get to be an expert in the multifamily real estate space. And likewise, I invested in a professional sports team.
Cool.
And, like a second tier startup league in rugby. And I mean, I know a lot about rugby, and I know a lot about business. And so for me, it was like the perfect marriage. But am I out there running the team? No. I just throw some money at them, and then I get to enjoy the networking. And I have some other things, some startups that I used to work for, where you exercise your options, things like this. So being diversified doesn't mean that you have to be an expert. It just means that you have to feel humans that are capable of doing what they're best at, and then you go do what you're best at. And similarly, I have a lot of people who want to be passive real estate investors, and so they're trying to start out with wholesaling or rentals, and I tell them, I said, you know what? Why don't you just go start a side hustle? It's something you're already really good at, like digital marketing or photography or being a massage therapist, whatever.
Yeah.
You'll start a side hustle, something you're already good at, and just take that money and throw it at deals passively. Do you really want to be an expert real estate investor? Do you really want to shift careers? Or do you want to just get passive income? And so we
Okay.
all have to answer that question, like, where's our time best spent if our goal is to be eventually.
Oh, you broke up a little bit, Emma.
Oh,
Yeah,
sorry.
okay. Yeah, no, I agree because, you could go into something thinking it's going to be more passive, like owning your own rentals, and then it becomes not passive. And it actually can turn you off from real estate investing, which, your expectations are different than what the reality is. So, and again, if you're not going to become the expert, why jump in with 1 foot, take on all that responsibility? You're having to put more capital into your own deal. And, in some cases, I think there's actually a lot more risk, but everyone's different. You can make money in any market, and there's a lot of different strategies. It depends on what what you enjoy doing, what you're good at. And we actually have a lot of full-time real estate investors that invest in our syndications, and they do it for diversification, because typically a full-time real estate investor is going to, have a niche in, say, a local market that they know very well, that might be in their backyard, that they have a level of comfort that they can, get economies of scale with just having, proximity to the various, rentals, but they don't have access to some of the markets that we're in. And so it's a great way to, still be a full-time investor, but leverage someone else's time and experience, and, have your money working for you in multiple places. And I always tell them, look, when we exit a deal and that money comes back to you, you have the option to put it back into your business if you've got great opportunities, or maybe your market, there's just not a whole lot going on and you want to roll into another syndication. So you get flexibility with that, but that's just as simple as, knowing what it is that you want, and that, you're smart enough to realize that, okay, like, I can't do everything. I got to rely on other people to help me. And that's, I think, a great way, if you can really kind of weed through what it is that you want, and then also know, what else is out there, so you can make that decision, I think is super important.
I tell a lot of people who contact me, and they just want to set up a relationship to see if they want to invest in a project that I have. And I always encourage them to meet as many operators as possible, because being overweighted in one area, and even one person, one operator group, I always encourage them, if you're going to throw some money throw like 50 or 100 grand at one deal, see how you like it, see how it goes, see how we get along, and then go find some more operators and throw 50 or 100 grand at a couple of those deals. Spread yourself around a little bit, because there are a lot of opportunities. And when I'm to the point now where I'm starting to get ready to throw some cash at these type of deals passively, it's not going to be in all my stuff. I'm going to go throw some at Ryan's deal, and I'm going to go throw some at somebody else's deal. So diversifying across operators, I've found, is also very important, because you just want to make sure that you're comfortable with your spread. But have you ever wondered if you're too diversified? If you're watering down returns, you've got some high returns, you've got some duds. If you're just getting mediocre returns, or maybe just too watered down, and you can't keep track of all of it. How do you keep yourself from getting spread too thin?
Yeah, that is a tough part of, investing over a long period of time in a lot of different deals, because eventually, yeah, it's a lot to keep track of. But again, I kind of go back to, hey, I made this decision. I believed in the team or the opportunity, and I'm going to let it run its course. But as far as, coming, tax time and just K1s and all that, yeah, I wish it was simpler. But, what I look at it is, part of some of these investments I make are to kind of test run maybe a future opportunity that, if it goes well, I want to bring that to our investors. So part of what I do is to really develop those relationships, try new opportunities, almost as like a case study, a personal case study, to see, hey, if this works out well, I mean, the way the team communicates with me, the transparency, if all those, boxes get checked and I get a level of comfort, it allows me then to maybe, bring something together to our investor base. But yeah, over time, yeah, I do worry that, like, I mean, it's not as bad being a passive investor. I mean, you can have a lot, but yeah, watering down. I mean, I haven't had that issue of say, investing in too many places and not feeling like I'm getting, value out of everything. But, it could, in time, could get to that point. And maybe that's where you end up, going in a little bit more on each deal, so that, you look at quality over quantity. And so I still got some runway. But I actually did that in crypto recently, because I felt like, God, every new, it was like every new startup could be the next one, the next, one that's going to go to the moon. And I invested in it. Probably had 70 or so different, coins or tokens I was in, and it was just so hard to keep track of. And then I scaled it down to like, all right, let me just go with the top 10 that I know very well and that I believe in. And it's been much easier to manage. And so that was just one example of, I had so much FOMO, and then I eventually said, you can't be in everything. There's gonna be ones that you're like, oh, I missed out on because, that one's doing well, but I got to look at the one that I put most of my money in. It's doing better than the others. So I've got to say, well, it's okay that I gave that up, because there's the opportunity cost that, I'm gaining by being, I guess a little bit more restrictive and trying to kind of go with, with what I believe is going to be the best. And so, yeah, you do have to let it go. You can get watered down. So I think once you get through that testing phase, like a lot of investors will say, hey, I invested with so-and-so, the syndicator, and it's the last deal I'm going to do with them. Well, that's a great way to like, hey, you tried it, it didn't work. Now that person's off the list. And then maybe your next one goes with someone else that you had a good experience with, and you eventually whittle it down, but you want to have, several that you can rely on.
So I wanted to ask you a couple of questions about your relationships with your investment network, because you went from being a passive investor to starting a syndication business. And you shared the story how you started those relationships, just going out and meeting with people. You had a success that you could come off of, like, hey, look what I've been doing passively. I was just able to quit my job. I wanted to share this with you. How do you nurture and maintain those relationships now? Because I know when we first spoke, I was pretty impressed with the size of your list, and you were mentioning usually you'll send a deal out as a capital raiser, and it'll be overfunded in a short period of time. How much time would you say you spend building that list, nurturing the people already on the list? Like, what do your communications look like, and how do you spend your time in your business? What's a average business working day or working week look like for you?
Yeah, I mean, I would say almost half the day is spent talking with investors.
Mm-hmm.
That is like probably the number one thing that I do. And it was something I also, made a decision that, I've got a lot of things that I do, and where is the highest value? It's in the investors. I wouldn't have this business if it wasn't for them. And I'm very lucky and fortunate to have them. So they're number one priority for me. And I make that very clear. I try to drop as much as I can to be there for them. And then the other, portion of my time is with the operating partners who we are partnering with, just cultivating that relationship, working on new opportunities, due diligence, all the things that go into putting a deal together. And then, I would say a portion is, project work, things like that, kind of behind the scenes, the operations of the business, the portal, distributions, putting together a newsletter. So it's a full-time job. I mean, I'll tell you, just with the amount of questions I get, whether it's email or phone calls, I mean, sometimes it can be overwhelming, but I do a pretty good job of, getting back to everyone. And if I don't have the answer, I'll track it down. So I think that would probably be one thing my investors would say, that, Ryan is, he's there for us. He's always willing to help. He's someone that we can count on. And I think that goes a long way, because my business today, I mean, I'm getting so many referrals and introductions from our investor base, and I don't even ask for them. They just come. And I think that's pretty cool, because, it means that they're having a good experience, and that they want to share it with someone else that they care about, or someone in their network. And so, I mean, my investor list is just growing organically on a daily basis, new investors. And there's no marketing involved. There's nothing other than, hey, we're putting good deals together. I jump on a phone call with every new investor, talk through everything, answer all their questions, help make sure that they're comfortable. And then I tell them what to expect, because we're going to have a monthly newsletter. We're going to have, upcoming deals. And I walk them through just the different phases and just, what the deal is going to look like, just so they can, picture in their mind, when that deal does come around, like, hey, they at least know what they're getting into and what to expect. And I do think that helps. So I try to kind of, be there for them and give, kind of tell that story, because when something does happen, it does happen quickly. And I just find that most have been ready to jump on opportunities. And if one doesn't work out, there's usually another one coming. So yeah, my day is really, again, all about the investors, the operating partners, and the deals that we work on. I mean, I don't have time for a podcast or to do anything like, those are things that, yes, would be nice to do, but I have to look at where my time is best spent. And right now it's with, the investors and our partners.
What are you finding to be the richest source of your new investor pool? Is it by guesting on podcasts or meetups like this, or is it mostly by referral at this point?
It's definitely by referral at this point. I would say early on, it was proactively reaching out, like on LinkedIn, different social sites, or just people in my network. And then I had, a phase where a lot of the podcasts were bringing in new investors. And that I think was a great way, or I was writing blogs and people would see that. And that's kind of the gift that keeps on giving, because once you put that out there, it's working for you 24/7. And so that has been great. But today, I mean, it's the best referral, the best investor is someone that's coming from a current investor who's already invested with you, because that new investor is like already ready to go. And typically they want to invest with their friend in that next deal or with that family member. So now you have 2 people or 3 people that want to invest. And so that part is, I think, the ultimate, level that you could get to in any business. And being in sales my whole life and being in business, you work so hard to kind of get to that point, or get that momentum where, things are, it's almost like, I don't want to say it's passively working for you, but it is in a way where, I'm not having to create extra energy to go find these investors. Our current investors are doing that for me. So that's bringing in, more highly qualified investors, but I'm also spending the time to help walk them through everything. But yeah, there was a period where I was the one trying to bring that all in. And it was probably the first 18 months or so. And I just did what I knew best, just network and try to cultivate relationships. And I was lucky that I think I had 15 to 20 years of being in the business world that I could tap into those connections, those people. So it might look like it happened overnight, but it was many years in the making.
What was your previous industry before you were able to, like you said, get out of your W-2? What was your expertise or training?
I was an insurance broker, so I was a producer and did large commercial insurance. So I did employee benefits, property casualty insurance. So I actually worked with a lot of business owners, but also kind of the C-suite, in those organizations. And part of my job was cultivating relationships and, centers of influence, people that would help me kind of get into the people that I want to connect with. And so, I think having a large network to start really, really helped, because there was a lot of people I could, reach out to from the get-go. And that's what I did.
That's actually a very similar industry. Did you find that you must have found that to be a pretty good source of at least meetings and then investors from that, because they understand commercial real estate already, a lot of them.
Yeah. And my focus from the insurance standpoint was with real estate syndicators, management companies. So I was, really close to that, that industry all along. And all my networking I did was at, real estate events. And so, yeah, I did try to leverage that as much as I could. But my investor base really is, are those investors that are not in the real estate space. They don't have access to these deals. They are too busy. They want someone else to find them. They want, someone that they can trust that's going to bring good deals. So a lot of, those newer investors are, people, working professionals or business owners that really don't have anything to do with real estate. Because I tend to find there's certain investors too that, like, you'll know right away, if this isn't a good fit, because they want to be more active and hands-on, and being in the syndication space and as a passive investor, it's not going to be a good fit, because you're not going to be able to probably do the things that you would want to do if it was, your own property that you owned outright. So that's, and there's nothing wrong with that. It's just, those are things that, you want to, that initial conversation, make sure you cover, because, I do, run into that from time to time where, you talk to someone that, really is looking for, maybe their own rental versus being part of someone else's, because you do give up some of that control. But, I believe that the benefit of giving that control, outweighs the control aspect if you were doing your own deal. Because I still, love to passively invest in other deals because, again, I'm leveraging someone else's time and expertise, and my capital is going to work for me. And yes, I could probably make a little bit more money if I did my own, but there's also, what's your time worth? I mean, how much time do you want to spend to go find that deal, or do you want to give up a piece because someone's got, a deal served up on a silver platter that you can jump right into? I mean, that's something I had to learn right away. It's like, okay, so if I did my own deal, maybe I make a few percent more. Well, how much time are you spending on that to manage it? And what is your time worth? I mean, that was something I quickly realized, like, yes, my time is, not worth a few extra percentage points to make this a full-time job managing tenants.
Yeah. Plus you're not responsible for the debt, and you're not responsible for any lawsuits. It's called limited partner for a pretty good reason. So we had some hands up. We got Jeremiah, and then Patrick, I saw your hand up, was up briefly. I don't know if that was
sure. Yeah.
But Patrick, Jeremiah, why don't you go ahead?
Sure. Yeah. I was curious, taking it a little bit back towards specifically the real estate investing, when we were talking about you getting watered down with stuff. It sounded like commercially you've invested in a variety of different business models. And I'm curious how you sort of built the knowledge base from your previous deals, or who you connected with to be like, okay, I can invest in this hemp cannabis operation because I actually believe in it. I think it's going somewhere. Like, how do you find that knowledge base, and who do you talk to?
Yeah, it's interesting how that one came along, and it goes right in line with, building relationships, because it came through a multifamily syndicator who I had invested with, and, they were from Colorado. They had some connections there. There was, a business plan, and it was like, hey, we're getting friends and family in here, and I know that this is an opportunity that just comes along every day. And honestly, I didn't know anything about that business. I just knew it was very lucrative. And I put money in based upon my relationship with that syndicator, who I trusted from a real estate standpoint. And they weren't going to be the lead operator on this. It was, someone in their network that they knew, that they believed in. So that was enough for me to say, all right, this is worth $50,000. Let me put it to work. And so that's just kind of how I invest. It's how a lot of our investors invest. But, if I stumbled across that, on my own, I might be a little bit more skeptical and maybe do more due diligence, because I just don't have, a relationship or a connection in. But when it was with someone I really respected and I knew and trusted, when I knew that they were going to be part of that, and I had the opportunity, I wanted to go in as well. I will tell you that, that's an emerging asset class that, again, if it does a quarter of what the projections are, it's going to be a phenomenal deal. But again, there's more risk, because in real estate, I feel like, it's pretty reliable. There's usually a constant, passive income stream, but this is, kind of once a year, there's a sale, of all the hemp, and, you're either going to make back all the money you invested, or, the crops aren't going to, produce what you thought, and we got to wait till next year. But I think when I first got into multifamily, self-storage, and mobile home parks, I really look back at, multifamily was always my number one. It's what I really believe in. I mean, I think at its basic core, humans need shelter, and that's not going away, especially affordable housing when you got, a crisis here in the US. So, you just look at that, and, just going through COVID, I mean, a huge pandemic. I mean, we were nervous getting into it because, when at the onset, we never were underwriting deals for COVID. No one ever knew this exposure. But, the resiliency of multifamily just held up so well. I mean, it was almost like a bump in the road when I look back on it now. And that was part of the reason that attracted me to multifamily, self-storage, and mobile home parks, because those were kind of like these all-weather assets that perform well, when we're in a boom, and when we're in a downturn, they hold up well. And over the last 25 years, those have been the three top performing real estate asset classes. So that's naturally what drew me to those. And, it's the cash flow, it's the value add upside, and the tax benefits And then after that, it gets a little bit more nichey, but again, the hemp deal was one of those where, I wanted to try it. I wanted to be part of it. And, it's almost kind of like an agriculture play too, where, I know farming is a pretty big, lucrative, investment, or owning land. And so this was just another way to further, diversify my investments. And, I'm glad I did it.
I'm looking at in our situation, and it's our base where we started really was house hacking. That's where we've made more money house hacking, at least cash in our pockets, than we have with anything else. And I've then used that to build into the multifamily. Come back, I'm able to take those and diversify into things that I don't understand as well. And I look at, like, we're still house hacking. Like, we're in our 40s. We have a bunch of kids. We have adult children who moved out, and we're still like renting out our RV pad. We just, the only deal I bought this year is a single family townhome where we're finishing the basement to create a little duplex out of it. Like, it's just so easy at this point. It's almost like in the background, and it allows me to put my focus onto multifamily, but you're just doing a few little things in the background. For me, that's house hacking. For you, it sounds like it's diversifying into some deals where you're not the active manager, but spreading the money around to protect yourself. And farming, like you said, it's a great hedge for physical real estate because they tend to be inversely related. And so it's just a way to almost like watering down your returns to stay more stable, to lose that volatility. So if you're always chasing the highest returns, sometimes you can get burned. And so sometimes there's some comfort in remaining stable. And for me, that sense of security really does come from a single family house hacking. I don't think I'll ever be able to stop doing it, just because we've been so successful with it. It's so easy and a no-brainer at this point. So I think it goes back to, what do you know, and where do you derive your security, and then where do you derive your returns?
Yeah, no, it's funny you mentioned that, because the one business that I'd started back in 2006 was in the sports ticket reselling space. It was when StubHub first got big, and I just saw an opportunity to buy season tickets. And I turned in, at one point I started with 2 teams, and I got up to about 75, and it became a multi-million-dollar business for me that I did on the side, and I got it down to a few hours a week of just running it. And I still actually have it today. It's nowhere near what it was before, just because a lot of things have changed, and there hasn't really been any sports games to attend in a while. So it's almost like it's gone completely away. But it's been that capital source that's just given me, extra funds over the years to put into real estate. And I told myself when I first started investing that, I wanted to have something to show for it, because I realized that business could go away at any point in time. And I wanted to have, something that I built from it. And so I took a lot of the profits from that business and, and I put it into real estate, and I could get out of it today. But again, some of it's pretty easy from the standpoint of I put in the hard work many years ago. I got access to some really good tickets, and it's just one of those things where, I've scaled it back, but it's still there, and I still take profits from there and invest in real estate. And, it's kind of one of those, again, side hustles that I was able to do along the way that helped get me ahead and really give me that extra money to invest.
Yeah, tell me about the sports, man. I own a professional sports team.
Yeah, rugby.
That's what I invested in the year before COVID. Like, yay!
You never know. That's what could be one of those niche sports that could do really well. And that's always been a dream of mine to get into the owning a portion of a team. I mean, those are all syndications. I mean, the way they're set up, and so that'd be kind of cool someday to be part of something like that.
Hey, talk to me offline. I've got a huge one if you're interested.
All right.
I think it's just one of those things where, like you said, we couldn't underwrite COVID. We just didn't know that was coming. I'll tell you that that investment in that team last year probably got me most of my business losses on my taxes, even more than real estate. It was a rough year for sports, but it made
we're gonna need some of those losses with the tax reform coming. So,
oh boy, yeah.
That'll probably be just, again, as being in this space and just looking at our investors and everything, like, those are things that we're looking at, is like, all right, if the landscape changes, from capital gains or 1031 exchange, how do we pivot? What does that look like for our our situation. So, those are things that, we don't have a clear answer on yet, but we're looking into and trying to give ourselves flexibility so that, we can pivot if needed.
Yeah, it's exactly the same situation, when you own a sports team and COVID hits and suddenly your whole season's canceled and you have something else. I had multifamily real estate and house hacking to fall back on so that we're still making income. It's just nice to be able to diversify across different sectors. So I had one more question.
I saw a hand was raised too. I don't know if it's still there or no, but yeah, if you got a question too.
Jeremiah, would you mind just from a technical standpoint sharing how you manage this base of investors? Because humans can't remember that many people goals and how do you remember who to call, who to tell? Like, what does that management system look like for you?
Yeah, so pretty much everything is run out of MailChimp, like our email campaigns, everything syncs up. I also have a CRM system called Pipedrive. But what I do to really automate everything, like my calendar and setting up new calls, everything is done through Calendly. So when a new investor signs up on our distribution list, we immediately we'll send out a link to it's all automated that an investor will click on, and we'll set up that call. It links up to my schedule. But usually, when I have that call, I'm getting a chance to learn about that investor, their background, kind of what their interests are. And, I'm taking notes along the way so that I can, reference that at any given point in time. It is hard, to remember everyone from every investor, but if I have got a scheduled call or if someone just calls me out of the blue, I can quickly go into my MailChimp and I'll have all the deals tagged that they've invested in. So I at least know, okay, maybe there's going to be a question about this deal, or maybe, there's a couple bullet points of things that, from our previous conversation that I know this investor likes, just so I can be prepared and, have a good feel when we do have that conversation. If it's something planned in advance, then I can kind of obviously go back and look at all my notes. But through MailChimp, is really where I'm able to organize and tag each investor so that I know what list they're on, what deals they're in. And that's probably the quickest way to really, know, when questions come in, what deals it might be associated with. Other than that, new investors, I'll also do a quick Gmail search of just, the contact and, the previous conversation, just so I, can get prepared that we might be talking about, that certain topic. But sometimes it is overwhelming where you're kind of, trying to go back and recall and so I just try to do the best job that I can. And I think investors know too that, like, look, sometimes it's hard to remember all the deals you've invested in, it's like, you do your best and so, most of it is all tracked. So I could recall it, if needed, if I don't remember it.
Do you do every deal with the same team, or do you switch teams and you come in as a capital raiser into different teams each time?
Yeah, so I come into different teams. So we're joint venturing the deal with the lead sponsor. So I'll typically get a phone call when we're getting close on a deal, or maybe there's consideration of of acquiring this property, and then we'll run through the numbers at a high level and see if it makes sense, if it'd be a good fit, and then we'll kind of divide and conquer some of the roles and the responsibilities there, and then I'll typically put up earnest money with the lead sponsor to help secure that asset. Then we go through the underwriting, due diligence, and then if it all makes sense, then we would go out to our investor base. And so we're essentially splitting up the equity raise with the lead sponsor. So depending upon how many investors they think they might have in the deal, how what our interest level is, we would all kind of pre-negotiate that ahead of time, and then collaborate too, because sometimes they might need more, we might need more, and you just kind of work together. And so it's deal by deal, team by team, and a lot of that's focused on the 4 or 5 partnerships we have. We'll just plug into the team when we get that next opportunity, and all of them work very similarly. So for me, it's kind of not much difference from one to the next, and a lot of that's by design too, just because we created it that way, and it's worked out well, and it's why we have a lot of opportunities, because we basically have 4 or 5 teams out there looking for deals every day, and and we've got a great system that almost it works so well that it's like to take on anything new is it's got to fit, it's got to work, it's got to we're not just interested in trying to you know, put something in that's going to be a one and done. I mean, we want to build that relationship with someone that we really believe in, because our investors will get more comfortable over time with the various partners. And so we want to make sure that, it's a reflection of our reputation, and we want to make sure we get that right. And so far, it's worked out well, but I am, at some point going to, likely build a little bit more internally here, but we've been able to plug in through the back office of each team that we work with.
Are you raising into a multi-offering fund structure that you have, or are you creating a syndication fund for each of these deals separately?
It's typically a separate LLC for each property that we acquire. There are some more of the niche assets are more the fund structure, like the ATM Fund. We created a special purpose vehicle for that to invest in. Same thing with some of the self-storage deals we've done. But the multifamily tends to be a direct asset investment. So we're just creating one LLC, and all the investors, invest into that LLC, which, holds title to that investment property.
Like a 506B, 506C type of fund structure for those, just one asset in it at a time?
Yeah,
Okay.
yeah, and most that we do are 506B. We've done some 506C deals, but yeah, the 506B is a little bit easier when you have pre-existing relationships. It's easier for the investors, but the 506C, some of our partners, from time to time, they want to get that exposure, and you can advertise those deals. You don't have to have a pre-existing relationship. So every once in a while, it gets mixed up, and there's various reasons for doing that. But I would say the 506B is what majority of most syndications are set up to be.
Have you ever looked into doing a multi-offering fund like a 506B, but it's a blind fund where you can just keep raising into the same vehicle, or is that not something that's a good fit for you?
That actually would be nice, because all of our investors, I mean, I don't advertise. We don't go out to outside of our group. So that would be ideal for me. A lot of times we have to follow the form. If it's the initial deal, the big fund is a 506C. They want us, if we create a fund, to be a 506C as well. So we have to go through that extra layer, even though, all of our investors, we've got that pre-existing relationship with, just because it does make it, it's one step that you can remove if you don't have to do that. But yeah, I mean, there's nice opportunities where you can get, multi assets into, a fund or a deal. And so I know that they're out there. Since the multifamily that we're set up the way we are, all of those have been, direct asset investments. And then the kind of the specialty, the ones that, for every 3 or 4 multifamily deals we do or we see, that's usually when, an investor's looking for that alternative every kind of 4th or 5th deal. And so that's why, the numbers are where they are as far as, where we focus, and, the number of opportunities we put together in that particular asset class.
Okay. Looks like we have 2 questions, Jody and then
Sure.
Jeremiah.
Yeah, what is an ATM fund? I'm not sure. I haven't heard of that one before.
ATM Fund. Yeah. This is a really interesting niche investment. It was one of those that was brought to my attention just through other passive investors who I highly respect, who have said, it's been one of their best investments over time. And so I had to look into it, and it was one that I made a personal investment into first before we put a fund together. But basically the ATM Fund is, we own collectively with all the investors like 4,700 ATMs. They're primarily in the Northeast, and these are ATMs that I like to say that they're not your bank ATMs where you're going to go and get a free withdrawal. These are ATMs that are used by I would say a certain targeted consumer who is really the unbanked or the underbanked. So it's people that would be going to the grocery store, and they're going to go withdraw, money at the the ATM or at the bodega or the airport, and they're going to pay $2.50 every time to make that withdrawal. And it's just, that's just their bank. That's how they, access money. And it's a very profitable business. And so the way it works from a fund perspective is that you as an investor make that investment into the ATM fund, and your money, 100% of it goes to actually purchasing new ATMs. So you get the equipment write-off. 100% of your investment is a write-off, which is nice. And then the pool of ATMs provides a consistent return. So it's a blended return. So it's not like your new ATMs that you're purchasing, you're only responsible for those locations, however, they perform. It's all based upon the whole portfolio. And it's been one, the operator since 2012 has never missed a monthly distribution. They've paid out the same distribution. And the way it's set up is, they do, again, all the heavy lifting. They cover all the costs, all the insurance, all the maintenance. And they basically, provide, there's no guarantees, but they provide a stated return. It's a 7-year fund. And the way it's set up is, they'll keep the upside of the deal, but they'll dip into their pockets if we're ever below kind of that monthly distribution. And they've never been below it. I know it's there's about a 30% buffer before they would even get to that. And so it's been growing like crazy over the last several years. And so investors like it for, it's a big kind of tax play. It's a lot of times at the end of the year, but it's just a consistent cash flow. A lot actually say it's kind of a boring investment because it's just the same every month. And there's really not much variation. Year over year through COVID, we were only down 1% from a transaction volume standpoint, because everything's based off of the number of transactions. And you only have to hit a certain amount each month to basically get to the number. And so the profits are divided between the investors, the management company, which is the operator, and then the actual store owner gets a piece as well. And so they're incentivized, to move into some of the newer ATMs that we're putting in, because each new ATM or each new contract, the ATM comes with a video topper, kind of like an iPad on top of it. And that's already a fixed cost that we've already accounted for. And we're beta testing, proximity marketing, advertising, and someone could buy gift cards, send money. I mean, so those are additional revenue streams that weren't even, put into the pro forma that, potentially we could realize. So that's a nice backstop. Like if for whatever reason, I don't know, the usage went down, or even, if something happened with cash down the road, it's a way to kind of offset if there was any variability in kind of the overall investment.
I know I heard about ATM funds for the first time last year with Travis Watts. He spoke at our thing about I don't know, a couple months ago, and I had no idea what it was, but it's just like you said, it's one of his paths to just really consistent cash flow. Even though he's 100% passive investor, heavily invested into multifamily real estate syndications, and then he's bringing up these things like ATM funds, and there was somebody else telling me about like the no credito, no problemo auto loan funds, and they're really. And as I've learned more about fund creation for multifamily real estate, I've been discovering there are funds for everything. There are funds for almond orchards in California. There are funds for Bitcoin. Yeah, there are funds for and once you meet operators who you feel like trust, and it would just be again by word of mouth, like, hey Ryan, what's something that's non-real estate related that I could invest in that it's been a good deal for you? And you say, hey, you should check out these two guys, and it's just word of mouth. But the fund, the availability of the different investments through the same 506B and C fund structures that we're using for real estate, for all sorts of other assets, it's like this whole world out there that I didn't know existed until just this last year.
Well, and it's kind of fun. I mean, it's like we invested in a food hall in Nashville, Tennessee, and like, when would I ever get that opportunity? And it's a bet on Nashville, and I'm sure it's going to do very well. It just recently opened up too, and like that was a fun project that a lot of investors had interest in, and it was again through our network, our relationships, and we're actually investing in a business, and it's kind of interesting because it's in the food, fast food, kind of fast casual space, but it's 20 food stalls or 20 operators. So it's not like all of our revenues tied to one successful restaurant. And then, where most of the money is made is in the liquor sales. And we've got 8 bars that are on this, top level of the biggest development that's ever gone into, the city or the state of Tennessee. And it's in downtown Nashville, right outside of Bridgestone Arena and right where Amazon just expanded. And it's all a traffic play. I mean, the more people, the more money we're going to make. And it was a fun investment, and it's all based upon, the revenue, food sales, licensing, just a different aspect. And so, and just to hit one more thing on the ATM fund that you talk about, like diversification, and, it's not correlated to real estate. It's not correlated to the stock market. And it actually kind of works in reverse to a real estate deal. Like if you think about it, like real estate is dependent upon, an exit and a cap rate associated with it. The ATM fund has, there's no risk in a cap rate because all your money is made through the cash flow. I mean, at the end of the 7 years, we're going to sell the ATMs for salvage value. And yeah, it's minimal. We're not getting much. So again, the returns are all based off of, the actual running the business. And so you don't have, if cap rates change in real estate, it's not going to impact the ATM, business. And so that's another way when you think about how deals are structured, that I think it gives you that nice diversification that, again, if the economy is doing really poorly, you might not have an impact at all in that type of investment because there is no, future sale that we need to hit to really generate the return. It's all based upon the current usage.
About how much are your returns?
So right now it's been performing at like a 23.3% cash on cash return.
That's really
and
good.
the IRR on it's about 17%. So this is the type of deal that it's almost like having a mini refinance each year. If you're getting 7-8% on your cash flow, you're getting 23-24%. You take that and you reinvest. And then, what's the ultimate IRR over a 7-year play if you've invested, a quarter of your investment every year back into some other investments? So that's really, it's not the best return if you're just taking the money and just not doing anything with it, because it's all about having your money, in motion and being reinvested. So yeah, so it pays out, but it's also a little bit different from a real estate deal where, you don't get your initial principal back just like you do in a real estate deal. So all the money is flowing through in the cash flow of the business. So you really have to look at it from an IRR perspective. So you would be comparing it. It's, a 16.5% IRR. And again, it has different risks than real estate, but when you can magnify, the cash flow that comes in and reinvest it, then who knows what that IRR will be. But just having that ability to do that, I think makes that deal pretty attractive. And then the tax benefits too, because you're flowing through, most of that money tax-free, because it's over a 5-year period, straight line depreciation. But we're actually working on our second fund because we closed this ATM fund. We had opened a year. We closed it in December, and we're working on a new one. The only real big difference is that we're going to do 100% bonus depreciation. So investors, I think, will find that attractive, especially if they're looking for a tax play that, they can make an investment any month and in that first year get 100% bonus depreciation on that full investment amount instead of having to spread out over 5 years. So, so those are, again, some things that, looking and talking to other investors and things that are important to them. And, that's a great, I think, tax play, especially in the environment that we're heading into. A lot of investors have already expressed interest in having, the depreciation, be there up front because, it's kind of the name of the game in real estate investing.
And it goes back to what you were talking about at the beginning when your dad was saying, I wish I'd known this stuff existed. I mean, these 2013 with the changes to the way that we can raise capital is really when this kind of stuff, it either didn't exist or we didn't know about it. I mean, we've all heard to say, oh, this guy, he made lots of money because he got in on the ground floor of some tech company that sold them. And we're all like, I wish I could get in on the ground floor. And then I discovered angel funds, angel investor meetings. They get together at a meeting and they watch pitches from tech originators, inventors, and they decide what they're going to invest in. Like, oh, that's how you get in on the ground floor of a tech company. I didn't know that existed before, 10 years ago or whatever. And so we went and threw some money at a couple of tech startups. But you can only invest in what you know about.
Yeah.
And if what you know exists. And so just networking like this and just figuring out like how to be a passive investor and still have a specialty in something like multifamily real estate for me that's huge, because the multifamily real estate and maybe commercial real estate in general will always be the backbone of the portfolio. But it's just nice to be able to throw some stuff at other people who are willing to go and put cash in an ATM. I'm never going to do that. It's like the gumball machine.
Yeah.
Like, I'm going to run my apartments. You go put cash in ATMs.
Yeah.
You invest in my deal. I'll invest in your deal, and it all ends up working out. But
yeah.
Jeremiah, did I see that you had your hand up? I think we missed you.
Yeah, that's fine. I got a real quick question, then I gotta hop
Sure.
off and have dinner. But thank you for your time, Ryan. It's been
Hey, all good.
super interesting. I was curious, just because I am very new to the passive investment, and especially with syndication. Emma was kind enough to, I think you're right, it was either lunch or brunch that we had. Very kind to meet up with me, talk to me a lot about it. I'm just wondering what's sort of the best way to meet not limited partners, general partners who are interested in finding limited partners like me who have minimal experience but capital.
Yeah, I would say, there's a lot of industry events. I mean, that's a great way to connect. Like a lot of those that I go to, I run into, current investors, but I run into some of our partners, and it's a great way to meet others in the industry. And so, there's a couple big ones that happen. I mean, before COVID, it was, we were getting together, and that was a great place. I know there's some virtual ones that, like multifamily investor nations is a big one. There's probably 60 or 70 different speakers on there. A lot of them have, their own business or specialty that they are, bringing to kind of the investor audience. And there's a lot of networking that's done as well with other investors. And I know Joe Fairless does one, the Best Ever Conference. I've been to that before. I know Michael Blanc has one in Dallas. I've been there. Those are great ways to kind of, in one weekend or a few days to kind of meet a lot of different people and kind of, network and get to know some of the players. Obviously you can find a lot on the internet too. I mean, you can do some Google searches or, look at bigger pockets and try to kind of network there and see, who might have kind of what you're looking for. If it's a particular market, kind of, getting an idea for, who's kind of the go-to player there, the syndicator that, would be a good fit. And then I just would reach out and try to have a conversation, see what that experience is like. And if you have a good feeling and you kind of jive with that person and you think that like, hey, there could be something here, then I would start looking at it maybe more closely or check out a previous deal that they did or look into their track record, or find another investor, ask them if there's another investor that you could talk to who's personally invested with them, and then you can connect and find their, experience. So a lot of this is, I find and hear these opportunities through either, I have a lot of investors that, they've invested in other deals and they're like, hey, you should talk to so-and-so, like I just invested in one of their deals. Like, I think it's very attractive. And so I'm just, always open and, even though if it's like, hey, we're really busy, like we're not actively looking to take on any new opportunities, I always try to say, I'll have the conversation because you never know. There could be that day where that opportunity comes up or something happens and, and you've had that, previous contact and you can just kind of tap into that. So I think it's just, really trying to get connected with, who is, in this space. And the easiest way right now, I think, is virtually, because you don't have to leave to go anywhere, and you can get a lot of really good content, make some good connections that, I think you could follow up with after the conference and, make some, meaningful personal connections.
Lots of virtual connections, and you don't even have to buy them lunch, Jeremiah.
Yeah.
That's such a good selling point.
It's you actually get a lot of really good speakers that attend because they don't have to travel and there's not that, conflict really. So it's funny. One of the multifamily investor nation, that was a thing before COVID, and it was kind of one of the first big virtual ones. And then everyone started reaching out to, so Dan Hanford runs it. He kind of became like a consultant to the virtual, conference, circle or circuit, I should say. And now, everyone's doing it. And, it's a great way to connect with a lot of people in a very easy fashion.
And I've had a lot of people reach out to me after I'll do a podcast appearance, and they'll start the conversation with like, I didn't really feel comfortable reaching out. I don't want to bother you. Or I'm sure you're busy, that type of language. The reason we're doing podcasts is for networking. It's to meet people. And so we want people to reach out to us after we do an interview, because otherwise what's that value? If you want to be in a 506B syndication, you have to know the operator beforehand. You cannot get on the mailing list. You can't see deals. You have to have that introduction. It's like what we were talking about at the lunch, that it's like the magic words are, I want to be a limited partner, I'm accredited, or I'm not accredited. Yeah. And put me on your mailing list. Like, that's what we need to know to make these things happen. And so I think that that's great. Reach out to the people that you see who are speaking at conferences. Reach out to the podcast guests. Reach out to the guests at these meetups. We're here doing this to meet people. And if you walk into a conference and say, hey, I want to be a limited partner, and everybody would just want to be your best friend. Because everybody you meet there wants to be an active investor. And like Ryan was saying, it's definitely a different business model when you're dealing with people who want to be in running the deal versus people who just want to be LPs. It's two very different bases of capital.
Right. So Ryan, hopping off that, I signed up for the McKenna Capital sign up thing. I just went to the website, but is there a better way to reach out to you to make sure for those 506Bs, if you decide to partner with somebody like me, that we have that established connection? Like,
yeah, no, I mean, that's usually the way to do it. You get on the distribution list. And so, yeah, the next step would be I'll follow up with you. We'll jump on a call and we'll just, we'll talk through some things and just see what you're looking for. And then definitely I'll go into more detail and help you answer any questions. So yeah, you're doing absolutely the right thing. And that's usually the first step is setting that up so that, you can then have that further dialogue. And so, yeah, no, you're doing everything right. And I'm always happy to help too. I mean, again, with any other people in the industry that, based upon what you're looking for. I mean, it's a small world and always looking to help in any way I can. So certainly we'll do that when we chat.
Awesome. Thank you so much, Ryan.
No, thanks, Jeremiah.
That's worth the price you paid for admission, Ryan, right there. This is part of why, one of the reasons I want to create more of a community and a marketplace where people who are looking to place capital can find operators to place it with, because of that more of abundance mindset of there's plenty of money to go around. And I want each of my investors to be diversified across assets, across operators. And so creating almost a marketplace, that's not quite the right word, but a marketplace or dating service where operators and passive investors, whether they want to be joint partners or limited partners, can just meet each other and get deals done.
Yeah. I mean, because it benefits everyone. We're all making the piece of the pie bigger. It's not like I look at all this competition out there and we're taking from each other. It's like we're all creating more awareness. We're building this. We're helping others, and we're all going to benefit in some way, shape, or form. So don't be greedy over an investor or two. I mean, it's and again, it's up to them at the end of the day. I always tell them, like, look, they make the decision who they want to invest with. It's their money, so they've got to feel comfortable. And and again, it's their call.
That's it. That's the only way I met Emma, was to reach out to her.
Yeah,
exactly. It was just a phone call after a podcast, and you didn't have any of that. Oh, I don't want to bother you. We're just like, hi, I want to invest in one of your deals. I was like, okay. That's how we do. That's how we get it done.
No fear mentality.
Yep.
Yeah.
Yep.
Oh, it's great.
All right. Well, Ryan, I really appreciate you coming in. I think I identify so much with what you're doing. It seems like every answer that you give, it's like, yep, that's the way I'm doing it, or already doing it, or planning on doing it, or whatnot. So loved your insight. Love hearing about your journey. And I think it's inspirational for those of us, whether we're active moving to passive or passive moving to active. It's just given me a lot of good networking feels. We're all going to throw money at each other's deals and get so appreciate for the
thanks for bringing me on this on this. You do this monthly, right? Little meetup here. I mean, this is great, and so I appreciate the time and the ability to connect. So if you have any further questions, anyone can feel free to reach out. And Emma, thanks again. I really appreciate the time here.
Yeah, appreciate you hanging out with us. And Rob, thank you so much for the introduction. Next month,
you're welcome.
We are, so I think we're having a couple of different guests. We're getting the summer planned out. We're having Brian Briscoe on. I have some invitations out to a couple other heavy hitters in the space, all things passive investing. So we'll meet the last Thursday of the month. And we will be in touch. If you want to be added to the calendar invite to get a reminder, just shoot me a message at emma@highrise.group, or go to my website, highrise.group, and connect with me there, and I can add you to our passive investing group. on Facebook or LinkedIn, and I can add you to the Google Calendar invite so you can get a reminder every month. Plus, we have a meetup group. So whatever your flavor, we deliver. So, all right, I will see y'all next month, and appreciate everyone coming.
Thanks,
Okay.
Emma. Thanks again, Rob.
No problem. Have a good night, guys.
Good
Thank
night.
you too.